Well, so far the sell in May and go away saying seemed to have worked out. Of course, all of it coming after the FOMC meeting, so maybe that's the asterisk in the saying. Of course, in the last 20 years, you've all seen the tweets and the content that this whole sell in May and go away thing for 6 months hasn't really been the right seasonal move. Despite today's stuff. So I'm going to break down, okay, what do we expect now? Is this the beginning of the end of this bullish run? What can I expect in the short term? And when is this intermediate pullback going to occur? Where was the weakness today? I'm going to show you that as well as how to trade that weakness. So let's go ahead and get started. Today is Wednesday, May the 1st, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look first and foremost at the S&P 500, and you can see a little bit of an engulfing pattern. In fact, we'll pretty much get an engulfing pattern on all the indexes, but here on the S&P, we've engulfed the bodies of the last two candles. Now, you notice we didn't get below yesterday's low point. Well, we did by a smidge. We're basically finishing at yesterday's low point there. Sorry about that. And you can see also, too, that you got the momentum line in the reversal zone, and you have the intermediate line in the upper reversal zone. So that combination, by definition, is called an intermediate confirmation signal, a bullish intermediate confirmation signal. Now, that signal can be strengthened by the fact that the near-term line, after spending 7 days in the upper half of the chart, now, which is on the short end, but typical range, 7 to 12 days. So at least it got to 7 days. It's actually a good sign after only a few days there. But now it's down below 50. Okay, well, that's typically, it's setting up for a bullish low point on a near-term basis. But the red flag is that momentum line. You notice the momentum line did not just get in the reversal zone, but it fell all the way down to pretty much zero. It got to 1.01176. So that's an extreme low on the momentum line. And that can be a signal that precedes a posture change. You can see this one here got to 5.660 right there, and this one got and that preceded a posture change to a weak bearish posture, mind you, because that, again, remember, we're not going to go from strong bullish to strong bearish. We're going to go from strong bullish to first weakly bearish. And that's all we got there. And then here, same thing. The momentum line hit an extreme, and the next day the near-term line came down. Almost similar. You can see a big down day. And then the next day we got the near-term line came down. That preceded a posture change to, again, a weak bearish posture. And that's all I got, right? You hit the moving average and turned higher. Now, both of these momentum drops here basically got us to the moving average, and as of right now, we're not even to the moving average. So, put today's selling in a little bit of context there. It's a bigger down day than we've seen in a long time in terms of total points. 0.75%, so not quite a 1% mark there. I did want to show you this chart off of our charting package that we have here for our premium subscribers, Market Scholars premium subscribers. You can see here the blue line obviously is 1% moves. The orange line is 2% moves. Let's go to SPX here. Excuse me. Here we go. SPX. And you can see over the past year, like the historical volatility, the gap between historical volatility and implied volatility has really dropped pretty sharply here. And the historical volatility is about as low as it's gotten since back last September, October, right before we had an increase in historical volatility, obviously. But you also notice that we've only really, during this whole rally, we've had a few 1% up days, but we've only had the 1% down day there, no 2% down days. And then we had initially a 1% down day right over here early on, right after January expiration. So we've really kind of, like, this is a relatively big down day compared to what we've had here lately. Absent, that one down day here back on March the 22nd. So you go back to the market forecast chart, and you can see, okay, well, one down day does not create a bearish trend, and the expectations actually is if we don't bounce, we at least will probably kind of hammer around a low, potentially drop at the very worst down to the moving average based on past precedent. But that's about it. So we're expecting this intermediate pullback, but today isn't necessarily the beginnings of that. Not any more than we could say that March the 22nd was. And you can see the same pattern engulfing with this intermediate confirmation signal and extreme lows on the momentum line. The near-term line for the NASDAQ actually got down below 20. And then you can see, of course, the Russell 2000, which never did get above 1600, mind you, at least on a closing basis. Never did get above 1600. So, that's a pretty significant move for the for the Russell, and kind of shows, kind of how weak the later stages of this rally has been. Whereas Russell led the early stages higher, it's been relatively sideways since. All right, before we look at some other charts, a reminder, subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen, then click that red subscribe button that pops out. Hit the thumbs up icon down below the video. That tells us, number one, you like the video today. Number two, you want us to do it again tomorrow. Quick, easy way to give us feedback. Comment also down below, comment on anything that stood out to you from today's video. Join our Daily Market Outlook email list. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe. Very easy way to do that. Follow me on Twitter for more content like this in between the videos. And then join our Market Outlook community that we created on Facebook. If you're watching our video on our blog, on the blog post today, there's a few things you can do on this page too. You can subscribe to our email list by filling in this form and click on that this button. Also, you can share our video with people on in your Facebook. On your Facebook or on Twitter, or especially on LinkedIn. If people are interested in this kind of content, you can share it by clicking on either of these buttons. Very simple way to do that. Finally, you can comment on today's video in our Market Outlook forums on MarketScholars.com. You have to subscribe to our site, but you can do that for free by clicking up over here, but then go to the forums and open up any new threads or reply to anybody else's threads in the Market Outlook forum. All right, if you take a look at this week's candle, you can see what a difference today's selling makes. So only our, fourth down week, fifth down week of this entire run that we've had. And if you look at it from a Heikin Ashi perspective, still a bullish candle. So it's going to be, you see how much of a pullback we'd need to even just get a transitory candle here in the Heikin Ashi. So that kind of puts, again, today's selling in a little bit of context there. Going back to the normal candle there, you can also see we're not even below yesterday's we're not even below yesterday's midpoint yet. So a little bit of a down week, but not a trend changing, especially look how bullish the momentum is. Again, this just amazing how it's gone from as bearish as it was to as bullish as it is without any hiccups in between. It's a little abnormal for that type of pattern. Not abnormal to come off lows like this, but abnormal for that type of momentum swing in such a short amount of time on the weekly chart here. Now let's take a look at the 3 green arrow chart. And you can see for the S&P 500, again, we got one red arrow, but it's the MACD red arrow, and it's the one that we've been kind of oscillating between. So again, it shows just how bearish we were today, or not bearish we were, because again, we scratched the 8-day, we went just a smidgen below the 8-day exponential moving average. The MACD and stochastics are both below their moving averages, but they're both still easily above the midpoints of their charts. So any weakness we get right now might end up looking just like the last two, for all we know, right? For all we know. Now, at some point in time, we'll get more, and as I mentioned before, the expectation is just for Fibonacci pullback would be down to 2,800, a little bit above 2,800. So that's 125 points away roughly from where we're at right now. So it's going to be uncomfortable if and when we do get that pullback, because we've been so bullish. The intermediate pull, and that's just at 23%. If we were to go all the way to 38%, which is typical, that's at 200 points down. So it's going to be uncomfortable for those who, especially those who went the most bullish in this area. But it won't be unexpected. Right, but I don't think that today's selling necessarily is the beginning of that. At least that's not what today's patterns are telling us yet. It could, but we're not. I wouldn't expect that we'd get this kind of move or that we're even close to getting over here, because again, we're easily above a rising moving average. We're not even threatening the 30-day moving average yet. We just barely dipped our toes under the 8-day. So any kind of pullback we get, there's got a long ways to go, and today is hardly the beginning of, I think a lot of times we see a sell-off like this and we think, oh, we're going to get this kind of move or this kind of move, and the reality is we probably end up get like this kind of move, where after we get the selling, we just kind of flatten out and then eventually bounce. The problem is, the expectation is, when we do bounce, don't expect it to bounce for very long, because we're already 3+ going on 4 months now in this current intermediate run. So these near-term runs will start to get smaller and smaller until eventually we get the intermediate line pulling back, which is typically what happens when we get this kind of cluster that we got earlier with that last Friday, that overbought cluster that has all 4 lines. In the last 5 years, those types of patterns typically precede the intermediate line dropping below 50. Not new bear markets, but just getting back below 50 and getting that type of low point there. All right, now when you take a look at today's intraday move, you can see that all of the selling occurred here right after the FOMC statement came out, meeting and statement came out. You can see the declines finishing by the end of the day, at the lows of the day, at least close to the lows of the day, a few hundredths of a point off. Pretty much at yesterday's low point, after getting a new 4-week high, slightly new 4-week high point, right before, or right as the FOMC was released, the FOMC statement was released. Again, there's your Heikin-Ashi Open, so that's how much further down we have to go to get that. We'd have to break through these kind of intraday levels here around 291 to even threaten that area. And remember, this midpoint is also going to slightly move up to as this low moves up here. So keep that in mind. When you take a look at the range today and the volume, the range finally, after really, really small ranges, we got above average range, 3 points, and the volume at 71 million after a decent amount of volume yesterday. So when you look at the range here, 3 points is just a little bit above average. The volume at 71 million also a little above average, but you notice they're still low. So they're higher than average, but they're still low. Like getting a 4 to 5 point range, having volume in the 100 to 125 million shares, those are going to be like bearish days that will lead to more of a sustained pullback. Today was a pretty down day, but it wasn't so down that it was like significant, like that we're headed lower for a while. Again, we had a similar type of move over here on April 17th, and that's kind of it from that point. If you look at the volatility today, we hit the top end, the top end of the bullish range, the bottom end of the neutral range, between 90 and 95%. We didn't go above it, but you can kind of see again, like we talked about in the last video, that the monthly range for volatility was so low, 3 1/3 points last month, 3.36 points. Well, this month's volatility after only 1 day is now 2.09 points. So, and most likely we're going to get a range of volatility in the 6, 7, 8 point range, which means we'll probably end up threatening, the 20 level. So we'll probably getting around 17, 18, 19 at least sometime this month. And that's just to get kind of, and that would still even be a below average range for volatility. So, and it won't necessarily mean that we'll be that bearish, because we can come down from there. But that's the kind of move I expect. And again, but not until, again, after you see, go back to the hourly chart here. We're probably going to hit some resistance here on a short-term basis, and then kind of quiet down for the rest of the week after today's meeting. Most likely, of course, anything can happen, but that was most likely the pattern that we'd expect to see. So to summarize, we still have this bullish posture and bullish trend, and we had some more weakness today than we've seen in a while. That's not it, right? We still got more of a pullback at some point in time. I don't necessarily think that we're gonna get to that intermediate pullback in the next day or two. Today is a sign, a red flag, an extreme momentum low, and a sign that more is coming. But don't expect it to pile on itself in the next so many days. Expect probably now some small up days by the end of the week. Or even small down days, but nothing, like I said, it most likely won't pile on itself to where we just start tanking here in the next couple of days. But as we bounce, we probably won't bounce up this much either. And so that 4-week high point that we hit today, earlier today before the FOMC, that might be the 4-week high point for a while as we maybe kind of bounce up a little bit here and then start to work our way more towards that intermediate line dropping below 50 at some point in time, probably within this next month. So what do you think of that outlook? Do you agree or disagree with that? Click that link that's popping up in the top right corner of your screen up there. It opens up a poll, then hit either agree or disagree. If you click disagree, just comment down in the comment section below on what you're seeing that would suggest otherwise from what we just came up with here in our market outlook. All right, let's take a look at now what's driving the price action for today. And you can see the only thing that were up today over here on the left was bonds and the dollar and a little bit of real estate. You can even see gold was down. It's obviously mid cap, small caps, dividend stocks were all down, growth stocks, emerging markets, higher beta, you expect those to be down. And then you can see high yield bonds coming in way below long-term treasuries. And you can see, like I said, gold and commodities down, as well as emerging market bonds. There's commodities, the whole crude oil and commodities down. And of course, even short-term and long, some of these short-term bonds were all down today. So kind of interesting pattern where just about everything was down except for the dollar, which the dollar's been pulling back, kind of this fake out move that it's had. A little bit of a bounce back today. Here's how these asset classes looked. And you can see, like I said, you got that FOMC meeting here, and emerging markets kind of spiked out of it, and then everything came tumbling down. All risk asset classes came tumbling down, and the dollar, which was down, bounced up. So the dollar kind of, this reaction to the Fed today was a bullish dollar reaction, not as dovish as they expected. Now, whether or not that's going to be enough to keep this breakout afoot, or whether we fill in that low, because by the low of the day we had pretty much gotten back below the old highs and true fake out. So most likely the next few days we'll probably end up filling in that range back towards today's low point on the dollar. Because if you look at even the Fed the rate cut odds, we still don't have rate hike odds, but you can see the cut odds drop down. So we had odds that we would cut by the end of the year, by December, of 66% yesterday, and now it's down to 54% roughly. So now again, the rate hike odd, there's no rate hike odds, so it's not like the Fed's going to raise rates, but the Fed's not nearly as dovish as the market had expected. Is that going to be a significant change? Well, remember, the macro environment is not necessarily bullish here. Economic growth expectations, if you take a look, something that stood out to me earlier today in the futures contract before the FOMC meeting was copper futures. Copper is a base metal, and it's kind of a reflection of economic growth expectations. And you notice that big breakdown there. That's not necessarily the best sign. And then, of course, the 30-year yield, which is also more reflective of economic growth expectations than, say, than the 10-year. 10-year is more influenced by the Fed. And of course, the shorter-term yield is even more influenced by the Fed. And you can see how even again at the lows of the day, we were breaking down again. So you can see economic growth expectations in the U.S. are not that bullish. So this dollar bounce that we had today, just like the breakout before it here, I don't expect it to hold, and I expect us to fill in the rest of that range. All right, now let's go back and look. Let's look at crude oil here really quick, because remember that was one that came down too. And crude oil, while not necessarily reflective of economic growth expectations, again, you can't grow an economy without using those commodities. And you can kind of see we've had a little bit of a pullback. We're still kind of holding, but we're not bearish. Right? The trend is still bullish there. As again, with its link to stocks. Remember how we said last week that might be a little bit of a precursor to some weakness in stocks? Well, I think we got it. And we didn't break down further in crude, which is another reason why I don't think we'll break down too much further in equities before we get more of a near-term bounce. When you take a look at the foreign markets, look at all this pink up here. Look at the UK dropping down, even after some pretty decent news regarding Brexit there about some compromise. Breaking down, you can see Germany's breaking down too, but still above its moving average. You can also see China below a falling moving average now. So you've got a strong bearish posture on China, and you're below a falling moving average. Same thing with India. It's got a weak bullish posture, but it's below 50, and you're below a falling moving average now there. South Korea below a falling moving average. Russia pulling back now below its moving average too. Brazil breaking down. So you can see these emerging markets, especially, but even these developed markets. Getting into developed markets look more like the U.S., but the emerging markets are looking like a little bit more of a sustained breakdown here. In the sector rotations, you can see some interesting patterns developing. First of all, over here on the left, you can see the biggest losers today were materials and energy. Energy now has got, like healthcare, it's got a red moving average, and it's got a strong bearish posture. But you can see some of these others, like look at this engulfing pattern on staples. Look at where's discretionary. Up here, you can see discretionary pulling back. In fact, you notice that's the other pocket of weakness here is consumer stocks. Staples and discretionary both are weak. So you got dollar sensitive areas, consumer stocks. On the other end of the spectrum, technology and communication services, so your type of FANG stock still kind of rallying, so holding up and outpacing the market. So this isn't like a huge risk off move. It's just kind of limited to a couple areas that are getting weaker. So as I mentioned before, as we get more and more bullish, your correlations start to get different. Instead of having everything moving in the same, you got some pockets of weakness. You've got one sector that's bearish. It's got a weak bullish, or it's got a bullish posture above 50, but it's not. You're not above a rising moving average. So you'd expect that to turn back around. You can see energy is getting to look more like that, and materials is now below its moving average. You can see real estate also kind of sideways, and utility sideways. And these other industries or sectors that are above strong rising trends. So the correlations are changing, and let's see if we can't take advantage of that pocket of weakness, especially in that consumer sector. All right, one very popular retail stock here, Target, which had this bearish move late last year. Of course, it was already kind of bearish before the market went down, but you can see how in December we had a really significant decline from 90 to 60, 33% decline. Well, we since have bounced up nice and filled in that gap and got up to some strong levels, but with this breakdown a few days ago, we are now below a moving average. We got dark pink shading, and we're below a falling moving average. We have a red line there. That's a bearish pattern. When you look at the 3 green arrow charts, you can see again 3 red arrows with that falling moving average. Decent volume down at the bottom. When you break those lines down, you can see the 8 and 17 are just now starting to cross the 30. Together, which tends to be pretty bearish pattern as well. You can see a little bit of a dead cat bounce where we gapped down, we bounced up on an intraday basis and traded at the top of the gap, or at the bottom of the gap, at the top of this little high, and then we've now starting to fall back down and potentially getting buried in the ground here. So it's kind of a dead cat bounce pattern. MACD is not just dipping its toe below zero, and the MACD and the stochastics are now easily in the lower half of their charts. When you look at the Bollinger Bands, you can see that we are kind of starting to threaten this node and breaking below that node into this space before we get down to this gap over here where there's a bigger amount of volume at 72.5. And then finally look at the DMI, and the DMI's got that picture perfect bearish pattern of orange line up above 25 easily, The blue line's below 20. We had a strong bullish trend already heading into it, and we're immediately kind of reversing that pattern here. And then finally, from a long-term perspective, you can see we came down to the 200-day moving average, and we've hit it. Now we're filling in the low end of that range. You see that 50-day moving average is falling, and we're losing some momentum there. So there's some opportunity for this to be pressured, if not go down, to be pressured. And of course, we don't have to buy a put. We can come over here and we can sell the $77.50 call and buy the 80. And you can see when I analyze that, that puts here. There we go. That puts the the break-even point, if you notice, right up above. Here, let's go back to the Bollinger Bands for target, and you can see the break-even is essentially at the inside the gap. So we'd have to get in the gap again, pretty much nullify this dead cat bounce pattern, and then that's when we'd take a loss. And there's a lot of volume between now and there. Look at all that volume that's weighing on top of current price. So it won't be easy. It's not impossible, because nothing is, but it won't be easy. So that gives us an opportunity to say, okay, well, then we'll sell that call vertical, and as long as we stay down, then that call vertical works out. We don't have to go down very much. If we do go down, we can get half of that, maximum gain of $85. If we can get to 40, what would that be? $45 or $43 or so. If we can get that first half of that, great, we'll take it. And let's move on to another trade, because again, you can see how long it takes for the other half to get the other half of those gains. All right, that wraps up our video for today. Now let's keep this conversation going by going to our Market Outlook forums at marketscholars.com. Any questions or comments you have on the video and anything I discussed in the video, or for that matter, anything I didn't discuss in the video, let's keep that conversation going in the forums. Open up any new threads or reply to anybody else's threads with what you're seeing or what you think, or anything you'd like to share as well. Remember to subscribe to our YouTube channel, click that thumbs up icon, comment on the video, follow us on Twitter for more content in between the videos, and join our community on Facebook that we've created on Facebook, as well as on marketscholars.com. Again, thank you very much for watching tonight. Have a great rest of your evening, everybody, and we'll see you all tomorrow.